Okay, good morning. Thank you for joining us. If you're out here at Cochlear, thank you for joining us online. If you're online, I'm Dig Howard, CEO. I think we're ready to go. Okay, so let's jump in. So look, very good result from our perspective. So we got 9% revenue growth there to 1.3 billion, and very importantly, we saw growth across the whole range of markets. So good developed market growth, very strong emerging market growth, particularly in the second half. When you remember at the first half, we said we expected emerging markets to come back in the second half. We did see that. So 11% unit growth overall, excluding the China tender, up more than 15% on emerging and 9% in developed. And very importantly, we invested significantly through this year, and we will continue to do that in line with our strategy to strengthen our market leadership position. And that certainly happened when we looked last year with the Nucleus 7 launch with Made for iPhone early in the year, the addition of the Android app late in the year, the Baha Sound Arc rounding out the Baha 5 portfolio, continuing to roll out the CI532 and Kanso, and continuing our clinical study on the CI532. And while those results are not publicly available yet, we do see some good early signs from the performance of the 532. So very confident about product portfolio, clearly strengthened over the last 12 months, and on the back of that product portfolio, we have seen share gains across many countries in the last 12 months. Upgrades, so upgrades continue to grow. So we had 9 months of Nucleus 7 from an upgrade perspective in major markets last year. We're very pleased with what we've seen in terms of the rate of adoption. So Nucleus 7 is ahead of Nucleus 6 at the same stage after launch. It's still obviously very early days in a 5-year product life cycle, but very good to see the upgrade growth at 12% there coming through in the services revenue. So I said we continue to invest to grow, and I'll talk a bit in a minute, just sort of country by country and by the segments in a little bit more detail, but focus on direct to consumer, the sales force expansion. We continue to invest in a bigger sales force and sales force effectiveness. We continue to work and expand our work into understanding the hearing aid channel and the referral channel, particularly for adults and seniors in the developed market, where we have increasing evidence of the effectiveness of cochlear implants over hearing aids, and us thinking and understanding that clinical pathway from hearing aids to cochlear implants. Part of that is the medical affairs function which we've expanded over the last year to build stronger evidence for why hearing is an essential part of healthy ageing. Healthy hearing supports healthy ageing. The economics of the intervention of cochlear implants and acoustic implants across all ages, that requires clinical evidence and it requires market access, and we have invested significantly in both of those in the last year. And our R&D was 12% of sales. Core of our competitive position is our product portfolio. We continue to invest very heavily and across all areas of the product portfolio. So developing our implants, our sound processors, our software and connectivity, we continue to advance each of those elements to build out the strength of the entire portfolio. And as you will have seen, our net profit, 246 million, up 10%, in the middle of our guidance range. We have maintained our net margin, which we have said we would do as we grow. We will reinvest everything we can while retaining net margin. And Brent will talk more about the cash flow generation in a few minutes. So let's jump in just to look by segment. So cochlear implants up 8% in constant currency, so developed market units up 9%. US and UK were standout, but also good growth across Western Europe and across Australia and Japan. And so the US, we had 15% unit growth in cochlear implants, and it's a really important market for us because of its size, but it's also the one where we have been working the longest at developing this adults and seniors segment and getting these conversions from hearing aids to cochlear implants. So to see that level of growth rate, strong growth continuing in the US is a really good sign that we are learning this, how to get this clinical practice change to get people into cochlear implants. And as we learn, we will expand and take these programs from the US and adapt them to other countries. So very pleasing to see the US growth rate, and we continue to learn. And the other part we see in the US is very good indications, very good funding. Whereas in Western Europe, as we've talked about, there are often indication limitations or there are funding limitations. That's why we've got to build the clinical evidence and the market access, which I've said we've been investing in, to change those indications, as happened in Japan, and expand the funding so that we have the opportunity to reach people who would benefit. So good growth in the US, good growth in Japan, certainly later in the year too, which is a good sign that that breadth of indications is starting to support growth there. Emerging markets, as I said, at the half year, we were gone backwards in emerging markets, a very strong comeback in the second half. We could see a line of sight through tenders coming through, but equally we have invested in putting more people on the ground in emerging markets over the last few years, and that is paying off in private pay areas and in stronger relationships with key clinics and hospitals through the various countries that we operate there. So good growth in the Middle East, good growth in China, excluding the tender, and we will continue to invest carefully in emerging markets, but certainly continue to invest to build our presence because there is a huge long-term opportunity there. Talked about awareness, indications and funding, the three biggest constraints on our growth, a core part of the middle point of our strategy, which is to grow the hearing implant market. And we'll do that through awareness, indications, funding. And as I said, most advanced in the US, so terrific to see the growth there. And we take the learnings there and adapt to other countries. Talked about direct to consumer and our sales force expansion. And very importantly, the senior segment is clearly our fastest growing segment. So we're seeing pretty much double-digit growth in the senior segment in virtually all of the developed countries. And where then we see a market like the US, which already has a bigger base of seniors and that growing faster than children, we see faster growth in that country. So part of country differences in country growth rate is the base that they're coming from. What's the proportion of adults to children in those markets, as well as the indications and the funding. And the volunteer network continues to grow, which is really important. So we know that a candidate who talks to a volunteer is more than twice as likely to convert, to make the decision to get a cochlear implant or an acoustic implant. We've got 4,200 volunteers around the world. We've had 1,000 of those volunteers in the last 30 days in contact with a candidate, either directly or through social media. So that candidate network is growing and is very effective. So let's move on to services. So services revenue, up now 26% of our total revenue, 15% in constant currency. That obviously includes cycle, a full year of cycle for the first time. 12% growth in upgrade revenue, so when you back out cycle. And as I said, very pleased with the rollout of Nucleus 7 from a company execution perspective and from a customer feedback and performance, and therefore we are seeing a increased uptake of Nucleus 7 at the same stage over Nucleus 6. Still very early days, still a long way to go, but certainly a very good start for Nucleus 7. And Cochlear Family that we've been talking about for a while now, very important in building our brand, in building our customer experience, is to be able to engage more directly and in a more meaningful way with our customers. So increasing Cochlear Family members by 70% up to 100,000 is an important step again in building for the future. Many of these are new customers, so the Cochlear Family membership is an important part of engaging with us so that we help them get great outcomes and we build our upgrade revenue over time. Move on to acoustics. So acoustics, very clearly sales were flat through the year. I think the thing to remember here is to look at the trajectory. So we launched the full portfolio of Baha 5 through late 16, so full year in F17. And what we saw in F17 is a large number of upgrades. So you've got to remember that our upgrades for the acoustic business go through the acoustics line in sales revenue, not through the services line. So when we launched Baha 5, we saw a big jump in upgrades last year. as people move from older technology to Baha 5. So we continue to see good underlying growth in acoustics, but we didn't match the upgrade jump that we saw in 17. And as we work through 19, we will continue to expand the markets in which we make the acoustics portfolio available. So there is more geographic opportunity for expansion in acoustics, and we will continue to invest in making that expansion over time. And entering a new market takes time, takes investment, but we see the opportunity, so we will continue to do that. And the Baha Sound Arc is an important addition to the portfolio, particularly for children, and not having a non-surgical option, which can be effective on its own, or a step to an implant at a later stage. So an important addition to the portfolio. So certainly long-term see good growth coming through in acoustics. So let's look from a regional perspective. So if you look at the Americas, we continue to see their great growth in revenue year on year. So as I said, 15% implant growth. The US, through its size and scale, through the proportion of seniors in the implant population, and through the indications of the funding, is a great market for us to test awareness activities. We continue to learn on awareness activities. Obviously, we have Cycle based in the US, and we continue, as we've said, to experiment carefully with Cycle to understand that hearing aid channel. But it's really very pleasing to see 15% growth rate in CI units in the US. It gives us confidence of the opportunity, it gives us confidence in the strategies that we are executing over time to drive long-run implant growth. And that is part market share gains, but a significant part of market growth as well. In the UK, so 7%, in EMEA, 7% constant currency. Very strong growth in the UK on the back of a very strong sales team and a strong product portfolio. We saw good growth across Western European countries overall. Some share gains there, some market growth. Again, across those countries, we saw seniors, all of those countries seeing seniors being the fastest segment of growth through Western Europe. As we've said several times, there are indication and funding caps through Western Europe. That's where our clinical evidence and market access comes in. These are long-run investments that go through our SG&A line to drive growth in these markets over a 5-year horizon. And we have seen some price declines. Now, you don't really see that coming through in the aggregate numbers, but in a few countries we have seen some price reductions in Western Europe as governments manage their healthcare budget. So we've talked about that for a while. We continue to see some pricing pressure. Not huge, but it is certainly there. And emerging markets very strong in the second half in EMEA, as it was in Asia Pacific. So moving on to Asia Pacific, you can see there 5% in constant currency sales revenue growth. But very much a story of two halves for Asia Pacific. Very strong growth into the second half across all of the Asia Pacific region. As I said, Japan, stronger second half, which traditionally Japan can have a weaker second half than first half because of holidays and so on. Strong second half in Japan. An indication, not confirmation yet, but an indication that the broader opening up of indications for adults is starting to see some traction in Japan. Greater China grew, excluding the tender, also grew very strongly. And the China tender numbers are there. But Asia Pacific, good second half, good long run potential. It is lumpier, as we've said before. The developed markets are more consistent growth rates. Emerging markets, we see great growth over time, but more variability in the short run. So with that, I'm going to hand over to Brent to talk through some of the numbers.
Okay. Thanks, Dick. The two key messages that we want you to take away today, that we continue to invest for growth, and that investment is not just in the P&L, a little bit in the balance sheet. And the second takeaway point is that we have a very strong balance sheet and cash flow to support that investment. They're the two big messages to take away today. In terms of the P&L, you can see there that's not a mistake there with the constant currency. It is exactly the same as the reported, the 10%. Remember, the P&L is over the full year in terms of the constant currency. It's not just the balance sheet rate at the point in time, which we all tend to remember. The euro was 6% stronger this year compared to last year, and the US was about 3% weaker. So the two of those combined worked out to be 10%, exactly the same as reported. The real takeout here is the gross margin improvement. You can see that's gone from about 71 to 73%. And that's a combination of a little bit of the weighting of services, as Dig mentioned, a little bit more, they've got a higher margin and some US product, but it's mainly because of all the work from the M&L guys. Another year of producing products that were released over a year ago, so they're getting better at it. But the global repair centre that we have in Kuala Lumpur, where we took 10 centres around the world, 10 repair centres, and consolidated them into one, we're really starting to see the benefits of that now. It's been a fantastic project and it demonstrates some of the efficiencies obtained by that. Not only people doing things, we've got the skill base there, all centralised, we get the labour arbitrage impact, and we're also seeing a better customer experience. So we're making things cheaper and we have happier customers, which is a fantastic result. We've taken about 20 million of that margin improvement and invested that into sales and marketing. And as Dig mentioned, a lot of these extra people in there we're not going to see the results of that straight away. It will be for the longer term, over 3 to 5 years. Things like market access, the health economics people, they're all in there. We have about 125 odd extra people this year compared to a year ago in the regions. A lot of that is in Western Europe would be the DTC work, which was about 2 years behind the States, the CPN network in America. So that's the bulk of that growth in sales and marketing, and the people working in global marketing on the market access and health economics, which has a much more longer term frame. On the admin stuff, that's got some of the some restructuring costs, and that's offset by other income below, with some questions about the cycle earnout. So they just offset each other. So in doing any of your modelling, you can exclude both of them because they net each other off. The other line to probably focus on there is the tax line, the 28%. Remember, we had the Trump impact last December, which was about 6 million or so, less the savings from January. It's about 4.5 million impact this year, worse. So that would have been 26.5%, that tax rate, if it wasn't for those one-off tax changes. Going forward, it would probably be around 26.5% going forward. So in modelling, that's the rate to use on the tax side. So the P&Ls, as you know, it's pretty straightforward, but it's a fantastic result for the M&L team in particular and the Global Repair Centre. In terms of the cash flow, last year was probably an exceptional year, that 260 million compared to the net profit at the time, and that's mainly because of some timing issues around going from quarterly to monthly tax, and we caught that up this year. But the overall thing is we're still 105% against net profit, and I think that's a fantastic result. And you can see we've been able to keep the interest the same as a year ago, despite that working up a high debt base, the 200 million or so down below that we spent in acquisitions in the last 2 years or so, and CapEx. The call out here is probably the CapEx line. As we mentioned in the ASX release, there will be a bit of a pop-up in CapEx this year, the next couple of years. That's for the China manufacturing plant, which is probably about 40 million per year for the next 2 years or so. That's a bit more than what we originally advised the market, because we thought while we're there, we're going to actually build a bigger plant than the original approvals for, because it is more efficient to do so. The other thing, we're investing a lot more into IT, in the connected care, which Dick spoke about. All the cybersecurity stuff obviously requires a lot more, so there's a lot more IT CapEx as well. And we're also moving offices in Denver and Hanover in about 18 months. So that will probably only go up for the next 2 years or so, and then should come back to the historical levels. So there will be a little bit of a D&A impact on that. So overall, great result in terms of cash flow. And that's a pet thing of mine. I love that because we actually chase the debtors. And you can see that on here, the improvement on the debtors, halfway down 5 days in constant currency terms, that would be about 8 days, which is a great result. It's probably a combination of good management, much tighter stuff, but also a bit of the mix where we've got more to Western Europe and US compared to a year ago, where we had more China and Middle East a year ago. But overall, you can see the capital employed there, it's a pretty straightforward balance sheet, and most of it's just our working capital. The next important area to look at is the net debt. Again, getting back to that better cash management around debtors and so forth. We applied that same discipline with our cash management, and we've really focused on that, and that's despite the high base from Cycle and Lane Cove and some of those acquisitions at the end of last year. We still managed to bring our debt down to lowest in 5 years. So I think that's another good result. We also use this as an opportunity to renegotiate our finance facilities, which you can see at the bottom there. The average debt maturity has gone out by 4 years, so we've de-risked the business in that way as well. There's nothing in current, it's all in non-current. So in terms of the net debt, that's a good result. We've got plenty of capacity there as well. And on the dividend side, that improvement in our cash flow has enabled us to reward our shareholders with slightly more than our net profit, going to 11%, but we're still staying in the payout target ratio of 70%. So that's it in a snapshot, but I think overall, over to you, Dick.
Thanks, Brent. It's certainly good to see the balance sheet strengthened. So I want to finish with a recap of our strategy and then get to our outlook. So recapping the strategic priorities, 3 priorities: retaining market leadership, which is about our product technology and our customer service. We've talked about investing in both of those and we'll continue to do so. Growing the hearing implant market, which is about awareness first, a barrier everywhere, access, and all that's got to be supported by clinical evidence. So very important part of our investment is to drive those. And we want to deliver consistent revenue and earnings growth. So we invest to grow, we have make sure we have a strong balance sheet, and we hold our net margin. And wherever we get gains, whether that's efficiency, whether that's interest, whether that's tax, we will be reinvesting that in long run growth to hold our net margin. The reason why we want to do all of that reinvestment is because of the opportunity. We've talked about the opportunity before. If we go back to our 3 segments that we're focused on, children in the developed world is about 60% penetrated. Adults and seniors in the developed world about 3% penetrated. And as we've said, it's the fastest growing part of our business. And then children in the emerging world about 10% penetrated. So when you look at these charts of long run growth, so the top one there is our cumulative life to date implant sales. So obviously that's going to go up year on year. And then our revenue over time. We have achieved long run growth over the last 20 years. We see that there is significant runway for us to continue to grow, and that is why we're investing so heavily in growth programs. And those revenue drivers and those investments apply to all of the categories of our revenue. So cochlear implants we've talked about, the direct to consumer and sales force expansion, new products, expanding the emerging market, but very, very importantly they're working on awareness, which are long run programs, and then the clinical evidence, our university partnerships, which we've expanded in the last year, building the clinical evidence, building our expertise in market access, all of those things, all of that wraps up to get adults and seniors treated with a cochlear implant being the standard of care past a certain level of hearing loss. That's significant investment over a long period of time to significantly change clinical practice so that we go well beyond the 3% penetration. Services, recipient base keeps growing, which drives our services growth. We talked about improving connectivity and engagement. The Nucleus 7 rollout is in the early stages of its life cycle. Kanso continues to be a popular product and we continue to add the list of countries in which Kanso is available over time as we receive regulatory approvals. And acoustics I've talked about, there is a market expansion opportunity. We have a strong product portfolio there and we will continue to invest in that product portfolio as well as expanding the countries that we offer our acoustic range in. So with all of that said several times, we will continue to invest to grow. We are driving operational improvement. You can see that through the gross margin this year. Where we get that, we will put that money back in to the business while we retain the net margin. And we want to make sure we retain a very strong balance sheet, so managing our cash flow very tightly and making sure that the balance sheet is strong. We have low debt, so we will be conservatively geared, and we aim to maintain a 70% payout ratio. So to finish then with our guidance, 265 to 275, so 8 to 12% growth. That's based on maintaining our net margin. We expect developed market growth to continue, as it has done over the last few years. We expect emerging market growth to continue, albeit with more variability in the short run. We will continue to invest on those priorities, retaining market leadership first, driving long-term growth second, and many of those investments are long-run projects. We've laid out the exchange rates that we are looking at for the future for this year, 75 cents. So currency obviously dropped below that over the last few days, but got to remember that we have hedging that mitigates the impact of currency changes to give us time to adjust. So when the currency drops as it does, we still have our hedges in place, which means that full benefit doesn't necessarily come through straight away. And I think the other important thing of exchange rates is they have been volatile and probably more volatile. We see an increasing level of geopolitical volatility. across many countries in which we operate, and seeing bigger currency swings in the short run and in the short term, and economies tightening in Turkey as an example coming out over the weekend or over the last few days. So we hedge the major currency. We are clearly still exposed in smaller currencies or smaller markets as currencies move up and down. But with that, we'll finish there and move to questions. Andrew, you might sit down for the questions if that's all right. These microphones work, yes? Andrew, you go. Oh, yes. Probably do, yes. People on the call.
Thanks very much. It's Andrew Goodsell from MST Marquee. You flagged a little bit of weakness in European ASPs. You've also had Baja run flat. Is there any effect of Oticon taking a greater presence in each of those markets?
Certainly, we're not seeing that from a CI perspective in pricing. This pricing comes from governments putting pressure on. As has happened in Australia in the last year with the prosthesis schedule, that was just across the board cuts. And from acoustics, look, Oticon is certainly a good company. They have a good product portfolio. They launched their power product after our Baja 5, so there's always, with a new product launch, some competitive escalation, but we're very, very confident of our competitive position on the acoustics front, and really that the biggest cause of that sales flattening this year was the jump in upgrades last year that wasn't to be repeated, rather than an underlying slowdown.
And just to follow up, I think probably either for yourself or Brett, but obviously you've seemed to have anchored yourself to sort of maintaining net margins. So I guess taking the opportunity to, take any leverage that's coming through the P&L to then reinvest. I guess two questions. I guess, are you seeing that as just there's an opportunity to spend more and grow the market, or do you need to do it just to hold market share, or just where you're coming from there? And then finally, do you see a day where some of that leverage would drop through? And
yeah, so the majority of that extra investment goes into growing the market. So that's the awareness, the access, the clinical evidence. That's where our, if you want, discretionary investment goes. These are, as I said, standard of care is a long-run project. That building out the evidence, changing clinical practice is a long-run project. It doesn't happen overnight. Us just learning about the hearing aid channel, and why is it that some people will move from a hearing aid to a CI? Why do some hearing aid shops refer on to CI and others don't? And what we see as the biggest issue is awareness of indications. So doing that education takes time, takes money. So the majority of the investment goes through growth. We said from a product portfolio, from an R&D perspective, that we aim to hold our R&D at 12% of revenue. So as revenue grows, the R&D grows. So that was the first question. Second one is when did we see that rolling off? Look, with 3% penetration in the adults and seniors market, I hope not in the short run, because I think when we see that rolling it off, it either says we've solved it, and at 3% we haven't solved it, or we've run out of ideas. And we've got a long run plan, and there's plenty of ideas to fund in that plan for future growth.
Thanks. David Lowe from JP Morgan. Perhaps if we could start with guidance. I mean, Dick, you and I have spoken before about what potential growth rates can be.
Yep.
But the year that we've just seen was impacted by a product launch. So we saw profitability weighted to the second half. I would have thought second half was more indicative of what's normal. And if we take that second half number and double it, we get to the middle of your guidance range. So, I mean, the question I'm pushing towards, obviously, is are you being conservative? Is there something in this that we're missing?
Look, obviously we've thought pretty hard about where the guidance is, and thinking about what revenue growth can we achieve, because that's the one that delivers the guidance, given the maintenance of the net margin. So we are confident of that number. I think you've got to look at the second half. So there was a big bounce back in emerging markets in the second half. That may continue, but it may slow up. And look, and product launches are an important part of share, but equally, the work to drive growth is in some respects separate to driving share. So when we're launching new products, we're focused more on the competitiveness and share. When we're not launching products, we can be more focused on growth. So I don't know. Over time you see sort of swings around new products. I think that will happen, but over time maybe that will flatten as we execute on growth programs.
Okay, thanks. And just switching to the upgrades number, because again, it sort of feels like a number that gets affected by the timing of product launches, and we saw cycle revenue in that services line for the first time. Can you give us some sense as to what you're expecting from that line, from upgrades and from services generally?
So we don't in our guidance break out the individual revenue lines, so I won't go to there. But look, it's still early days in the Nucleus 7 rollout.
Should we be assuming that upgrade growth rate can't be maintained because you've got a boost from a new product and therefore it sort of comes back to a more normal level? Any sort of sense on that one?
Oh, look, I think there are several things that affect that upgrade growth rate. Certainly new products is part of it, but we're only a very small way through the penetration of the available market. The biggest factor on driving upgrades is how many people got an implant or an upgrade 5 or 6 years ago, depending on the market, and what's our ability to connect with them. So we continue to see good growth, driven by the base, driven by our work on connectivity, and driven by the features of the product.
Thanks. If I could squeeze one more in. One of the investors has sent me a message just asking about Turkey, given you've raised it. Just what is Cochlear's exposure to that market? Is it meaningful?
Look, in an absolute terms, in terms of guidance, no. But we sell in over 100 countries. I won't say where Turkey ranks in that list. But these things do have an impact. 3 or 4 months ago, the Argentinian peso devalued 20% pretty much in a week. Both countries, we have pretty strong businesses, not huge in terms of our overall revenue, but those hits, do make an impact.
Hi, this is Craig Wong-Pan from Deutsche Bank. Just firstly on the Americas business, grew 11% for the full year, although down from 15% growth in the first half. Could you explain what the change there was?
Okay, yes. So there's parts of this is there's 3 parts to that revenue, obviously. So the acoustics, the services, and the CI. So I won't go into detail of exactly what happened to each of those, but I think the key number in the US is this 15% growth in cochlear implant business. The launch of our Nucleus 7 Release 2, so the CI24 and Android came in very late in June, pretty much the last week in June. So that has impacts on our services revenue where there's a base of the older implants, but we continue to see great growth in seniors in the US. We're actually seeing good growth in children too, which is because there is an opportunity for that in the US.
And then second question on gross margins, good sort of expansion there, although I guess part of it is probably due to lower tender sales for the year. I was just wondering what your expectations are for FY19, if you can make any comments around your gross margin expectations.
The tender sales actually picked up in the second half. So the volume of tenders. So as Dick mentioned, the emerging markets actually picked up. So if you think about it, the margin would actually drop in that case, but we actually were able to keep the margin well. But it will probably be in a similar range of the full year amount, not the second half amount, so the full year amount.
Not sure if we've got any more questions in the room, otherwise we'll move to questions on the phone.
Thank you. If you wish to ask a question, please press *1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press *2. If you are on a speakerphone, please pick up the handset to ask your question. Your first question comes from Saul Hadassin from UBS. Please go ahead.
Thank you very much. Good morning, Dee. Good morning, Brent. Hope you can hear me.
Yeah, can Saul. Thank you. Good morning.
Thank you. First question, Dig. Just I was wondering if you could give us a bit more colour on the performance of Cycle in the year, just because we noticed the reduction in that contingent consideration. So can you talk to its role in bringing referrals in terms of moving from hearing aids to cochlear implants, or maybe just separately, if that's not yet happening, just the performance of that actual software from an audiology perspective, please?
Yep, sure. So Cycle, our first goal with Cycle is to maintain and grow that business. Cycle grew during the year. The business is strong. There was that the earn-out that moved back into the P&L. Part of the original purchase was aggressive revenue targets that led to the earn-out. That made sense in terms of the original purchase. In terms of Cycle for referrals and CI, so as I said at the half year, we just started some experiments then. We have continued those experiments through the half, just very carefully with small numbers of clinics. Out of that, we are certainly seeing some referrals, but low numbers of referrals. The key thing that we are seeing there, which is confirming our market research, is the single biggest barrier is awareness of indications of CI. So the most common thing that we hear when we work with Cycle customers is that I don't have any CI customers. In my database, I very rarely see someone who has CI indications. And that's because people are thinking about CI indications going back 5 or 10 years when they're looking at profound hearing loss. Whereas the evidence that is there now and continues to grow is the effectiveness of cochlear implants for people with a 70 decibel hearing loss, not a 90 decibel hearing loss. So that's our biggest issue. It's where, and it's how we now are working with Cycle, is to work on that education. What really is what are the indications for a cochlear implant candidate? And where we have been successful in working with hearing aid, partnering surgical clinics and hearing aid clinics, particularly in the US, that's where we see the fastest growth rates on a micro level or a local geography in terms of CI penetration. So we're seeing it is possible to do that education, but it is hard, and it will take some time. So very pleased with where we're up to with Cycle. We are playing a very long game here in terms of understanding the hearing aid channel and what we need to do to support changes in clinical practice.
They also launched their Cycle Pro software in April at the AAA conference, and probably about 10% of their clinics now have moved across to the new version of Pro. So that was part of the reason for the earn-out coming back, because they're probably a little bit behind the launch of that, and that was the focus for the first 6 months. And but that's all going really well. They had a really strong final quarter. So.
Thank you. And just if I could just change track slightly, you mentioned as well some sort of early positive signs regarding the 532. We've seen some reports in Maud about some tip foldovers. Can you talk to just the reception of that electrode, when we might get some data, and is there an issue regarding surgical training for implement or insertion of that?
So yeah, a few points there. So certainly the results we're seeing, which it's under clinical trial, we're not at endpoint, so we can't release detail. But what we are seeing is a general trend of people hearing well more quickly with the 532. There is, and what we are absolutely seeing, which is confirmed, is very, very consistent placement of the electrode in the right scalar, close to the auditory nerve, which is exactly what we wanted from this electrode. It'll take time as the clinical benefits of that become clear, but excellent surgical results from that perspective. It does take, the technique for insertion is slightly different, so there is a significant upfront training that goes with the 532. So that we have been, as we rolled out, being very careful to put that training in place. There certainly have been some tip rollovers with the 532. Look, the reality on tip foldovers is they happen on all electrodes. There are scientific papers, there are images of all companies, all electrodes with tip foldovers. We have seen with the 532 in the earlier days a higher instance, but that has come down very significantly.
Right, thank you. That's all I had.
Thank you. Your next question comes from Sean Lyman from Morgan Stanley. Please go ahead.
Good morning, Dig. Good morning, Brent.
Morning,
thanks
Sean.
for taking my question. I think, Dig, if I heard correctly earlier on the call, you said that the latest upgrade is outperforming prior upgrade at the same point in time. I don't know if you could be a bit more descriptive around that delta and maybe call out some of the strategies that are seeing you achieve that.
Yeah, so certainly, look, it's very early days. So, 9 months into a 5-year product cycle. So, look, penetration numbers are still very low, but they're certainly ahead of where we were with Nucleus 6. And we think a few things drive that. I think each time we launch an upgrade, we are better at it. In terms of ramping up our volume, having the messages, we have improved our connectivity and engagement with our customers. We have a long way to go there, but it's on the right path. And the feature set in Nucleus 7 is a standout. The iPhone streaming, the iPhone compatibility. When we go out and go into clinics, meet with customers, that's constant feedback we get is how good the hearing experience is with Nucleus 7, how convenient the connectivity is. So it's a combination of all of those things that are leading to being where we are now. But look, it's still early days, but very pleased with where we stand.
Yeah, thanks, Dig. And very strong growth in units in the US. Could you remind us where you are in terms of the rollout of Cochlear Link, and maybe, again, a bit more descriptive around some of the benefits you see as clinics adopt that?
Yeah, so Cochlear Link is very widely deployed in the US. It's a building block for connected care. The first implementation of this in the US, which has been very powerful from a customer service perspective, is that when someone's sound processor fails or needs to be repaired, the Cochlear Link loads their map into the cloud. We can download someone's map from the cloud and ship them a replacement processor. So within 24 hours, or as soon as we hear about the need for a replacement. That gives a much better customer experience, but it also takes a significant load off the clinic. So the clinic now in the US, typically doesn't need to spend time with people when the processor needs repair, which is typically non-billable time. So it's not profitable for clinics to take that time. It takes capacity from their new implant work to do that. So it makes us, it's all part of our service offering to clinics and to customers from a speed of replacement to clinics in terms of taking non-billable work away to make us easier to work with and to create capacity for new implants. Now, the opportunity for Cochlear Link in other markets varies. So the issue in the US is that there is no reimbursement for dealing with repairs, replacement processes. In some other markets, those services are reimbursed. In which case clinics might be less willing to give them up because they lose some money, or there might be restrictions on us shipping directly to a customer in some places. So Cochlear Link is a building block which has a very strong and specific application in the US, but as we move to a more connected care model with the Nucleus 7 technology enables us to take steps down that path. Cochlear Link is certainly one of the key building blocks, and we use it in other markets in similar ways to the US. I just call out the US as one example.
Great, thank you, Dick. That's all I have. Appreciate it.
Thank you.
Thank you. Your next question comes from David Stanton from CLSA. Please go ahead.
Morning, gentlemen. Thank you very much for taking my questions. I wanted to talk about China tenders, please. In terms of FY18, in the second half of FY18, it was a little bit lighter than what we thought it would be in 18. I wanted to sort of understand why that is, and what does your guidance assume for tender sales into F19, please?
Okay, yeah, Dave. So first point, yeah, we won I think 1,498 units in the China tender. In 18, you saw in the numbers we shipped about 1,100. Therefore, there is some carried into this year. We said back at the half year that we were aiming to ship those in the last half, but the timing of delivery is out of our control. In terms of the F19 outlook, the China tender component is not material at all in our guidance.
So should we, just my follow-up then, should we assume a number in line with the final number for F18?
I think it could well be below that this year. So I think there was a tender a few weeks ago which we missed out on. So that will ship through this year. It's unclear if there will be another tender in the year. So it could well be that the volume going into China through the tender this year is below where it was in 18.
Thank you. Understood. Thank you.
Thank you. Your next question comes from Chris Cooper from Goldman Sachs. Please go ahead.
Hi, good morning. Hope you can hear me. 3 questions, please. Firstly, if I could just come back to the gross margin. If you could just give us some sense of how the incremental 200 bips breaks down. I guess if you could just roughly apportion it between, say, sales mix, country mix, maybe some efficiencies in FX, that would be very helpful.
On the sales mix, that's probably the least thing in terms of the weighting of services. Most of it's just the efficiencies from the M&L guys and the Global Repair Centre we mentioned. And as I said before, don't use the second half margin for annualising it because that it's more likely the full year amount that you saw there.
And there's an improved, I think there's an improved product design element in there too. That it's both design and manufacturing that lower our COGS over time. We've been working at that for several years.
Great, and your comment on mix refers to both sales and country.
So
the mix between sales and country. So it's like it's consistent with prior years. Most of that improvement is just as Dick said, the better processes from the M&L guys working more closely with R&D, getting better at it. Another year of product, and the Global Repair Centre.
Great, thank you. And if I could just ask a follow-up, please, on the Oticon implant launch. Can you confirm whether you've factored anything into any sort of competitive impact into your guidance yet, or is it still much too early to be doing so?
Do you mean the Oticon cochlear implant?
Correct.
So obviously Oticon is selling into a reasonable number of countries already. Virtually every country we operate in is very competitive. For sales, we clearly factor that competition as best we can see it into our forecasts and into our guidance. But as I said, we are very confident of the strength of our product portfolio, the strength of our field team, the service that we deliver, and the strength of our brand and our reputation. So very well positioned from a competitive perspective, but and it is a very tough competitive battle in most markets.
Okay, great. And just a quick housekeeping point, please, just to finish. Just on working capital, I noticed that the inventory levels rose during the year. I'd actually expected to see that number just come down slightly as we work through China and Nuclear 7. Can you just confirm that we should be expecting working capital to ease as we go into 19?
Yeah, it's just running up to the end of the year. We've had the launch of the R2 for Android, and last year the acoustics was, we had that fantastic finish for the year in acoustics, so that was a little bit lower, so it's gone back to historical levels for the acoustics.
Great, and we should be expecting a more favourable cash flow impact into 19 from 18, just purely on working capital?
Yeah.
Okay, all right, thank you.
Thank you. Our next question comes from Steve Wheen from Evans and Partners. Please go ahead.
Yeah, good morning. I just wanted to call out the 3-ish sort of, I guess, unexpected aspects to the FY18 result, which was the earn-out provision, the restructuring costs, and perhaps you could include in that the stepping up in tax. Just on each of those, that earn-out provision, there's obviously a large provision that's still there. What is the timing around the qualification, I guess, for the remainder of that earn-out provision?
So that it was a 3-year earn-out, so we're through the first, and depends on growth over the next 2 years.
Okay, and that provision that you release, is that in agreement with them, or is there a possibility that on the back of Cycle Pro that they might ultimately qualify for it? Or
No, it's based on the audited accounts, so it's all finished.
Yes, it's all set in the purchase contract.
They use the June year end for it, and we just do, and it's based on the results.
Okay, thanks. And so secondly, on the restructuring costs, where do we see those, and what were they relating to?
It's only it's in the admin line. And we call that out in the annual report for Chris. And it's only a couple of million worth of restructuring around the world.
Okay, and then just lastly, the effective tax rate, I guess, stepped up a bit. And can you just sort of talk through what's going on in that line?
So it should be about 26.5 if you took out the one-off impacts for the US. So remember we had about 6.3, we had about 5.8 in December, and then we had a little bit more of a catch-up in the second half. So the one-off impact was about 6.3, offset by the savings from 1 January. So it's about 4.3 million one-off in the P&L. Take that out, you're about 26.5% as your effective tax rate for this year. And that will probably be about the rate going forward as well.
Perfect. And then just if we look to FY19, is there any kind of one-off items that have been included as part of that guidance, like restructuring or something of that sort of stuff?
I think, Steve, perhaps an easy way to look at it is that there's always one-off items in a business. You can't predict everything. You make allowances for what you can see. It's why we keep coming back to we're going to hold the net margin. There are lots of moving parts. We've got lots of discretionary spend. Our goal is to invest as much as we possibly can in market growth while holding the net margin.
And when we sat here a year ago, we didn't know about the US tax stuff. We didn't know about, you just don't know about the one-off stuff. Usually it happens during the year.
Okay, thanks very much.
Thanks, Steve.
Thank you. Your next question comes from John Deacon-Dell from Citigroup. Please go ahead.
Hi there. I had just 2 quick questions. One, just relating to the cochlear implant growth. I just want to make sure my maths is correct. So you've called out that developed markets is plus 9% and the US is plus 15%. I assume the US is about 40% of developed markets. That means the rest of the developed markets are growing about 5%. Is that broadly consistent with what you're saying?
Look, I haven't done the maths from that perspective. I think what I would say is that it certainly sounds low when you do it, but I haven't done that maths. Your proportion of implants in the US is too high.
Okay, all right, fine, thank you. And just back on SG&A growth, it's a big number, but plus 50 odd million this year, and to keep your margins flat, it's going to be the same next year. Can you just give us a bit more colour around? Is it predominantly sales and marketing, or where exactly are you going to be deploying the increased expenses?
So through the SG&A line, the majority of that incremental spend goes into market growth, and it goes into it in a few different ways. So it is things like building out our market access capability. So we have hired through the last year a market access team in Sydney. We have hired market access people in key countries where we see that we have to expand indications and funding to maintain our long run growth. So we have a partial cost for those people last year. We have the full run cost this year, and we will continue to hire those people. We continue to expand our direct-to-consumer campaigns, both in terms of within country, expanding the magnitude of those campaigns and rolling to new countries as we build the sort of online marketing infrastructure to do that. We continue to work with the hearing aid channel, country by country, and investing to do that. A lot of investment around the market intelligence, background research to understand just what is the clinical path and the barriers to clinical path. We're investing in, and this goes more through the R&D, through our the university, expanding the university partnerships and the amount of money we put through there with Johns Hopkins and Macquarie University and other research partners to build out that clinical evidence. And the other line through the SG&A is to build out our customer engagement. As Brent mentioned, we've got some capex there to build out the underlying platform to support online engagement with our customers. We also have some SG&A spend to build out Cochlear Family, to build out the service offering, and to promote our upgrades through as people become eligible for a replacement process. So there are pretty much every growth program that we have talked about, whether that is through CI, through services or through acoustics, virtually all of the funding for that growth, and much of it is long term, runs through the expansion of the SG&A. And we have this year mapped out the next 5 years of opportunities of programs for us, and we will fund those as quickly as we can. But the funding of those depends on the revenue growth, and it depends on the operational efficiencies. But as we say, whatever we get, we are going to bring those programs off the shelf and implement them as the money comes in.
That's great. Thanks very much.
Thank you. Your next question comes from Lisa Clive from Bernstein. Please go ahead.
Hi there. I have 3 questions. Dick, first of all, I was curious to hear your comment about continued strong pediatric growth in the U.S. market. So I have 2 questions on the back of that. First, how much further do you think the U.S. has to go until it hits full pediatric penetration? If I were to guess, 85% of American babies with profound hearing loss got 2 cochlear implants today. Is that a fair estimate to illustrate this headroom still out there?
No.
And then the second question is...
Sorry. Can I answer that one first? Children born with severe profound hearing loss in the US, somewhere between 50 and 60% of those are getting cochlear implants. So that's well below the rate in Western Europe. It's well below the rate in Australia. We would like to see it get to 85%. There are, US, it varies state by state, so it's not a individual solution. It's been a problem we have and many others been working at for a while. So we don't have a clear view of the trajectory of growth or the ultimate penetration, but the US is one of 4 developed countries that stand out for relatively low penetration in children.
And what are the other 3?
France, Japan and Korea.
Okay. And then the second question is for Brent. Could you give us a sense of how your cochlear implant sales in unit terms is split between pediatric and adult patients in the US today, and also how that compares with Europe?
So I'll answer that one. So we're in the US, we're roughly 25 to 30% pediatrics, 70% adults and seniors. And we showed some data on this for Western Europe in our Investor Day, where we have the UK at about 50-50. Germany has a smaller proportion of children, higher proportion of adults, and that aligns with the broader indications. So US with broader indications, Australia with broad indications, 25% children, 75% adults. Countries with tighter indications tend to be more 50-50. And that's our growth opportunity, and it is why countries with the higher proportion of adults and seniors grow faster than those that don't, because there's more opportunity there.
Okay, thanks. And then just lastly, Dig, you mentioned the most recent China tender. Would you be able to shed light on who won that? And particularly interested in traction from some of the smaller players, particularly local player Neurotron, and whether they're really getting any visibility in that channel.
So I'll give you a little bit of information. So it was a tender split 3 ways with about 960 units in each tranche. There were 3 winners and we weren't one of them. So you can probably work out who the others were.
Was there a local player as one of them?
There was only 4 companies approved to sell implants in China.
Okay, fine. I'll follow up on that. Thanks.
Thank you. Your next question comes from Leanne Harrison from Bank of America Merrill Lynch. Please go ahead.
Hi, thanks for taking my questions. I'm just following on from previously around the adult market. And so you've made some good inroads into, I guess, the US, Australia and the UK. Can you give us some insight into the trend of the rate of growth in those countries and also how you're progressing with the remaining developed countries?
So as I said earlier, pretty much across the board in developed markets, we're seeing double-digit growth certainly in the seniors, so the over 65s, and that's based on greater awareness. Which is supported by our direct-to-consumer campaigns and our work with the hearing aid channel. And what we see with these things is there's there are sort of two steps. So there's one is that there's the hearing aid channel. So majority of people with severe to profound hearing loss in the developed world are seeking some form of help, and mostly that help is hearing aids. But the vast majority of those people get into the hearing aid channel but don't get out again. So there's work that we need to do in the hearing aid channel. The second part is the surgical end, is that and this is where the evidence is important. Surgeons over time are naturally and reasonably cautious in who they will implant, based on levels of hearing loss, based on the age of people that they see. And it is very much, there is both independent evidence, but there is personal experience. So a surgeon who does an implant for the first time in an 80-year-old will typically wait and see what the results are in that 80-year-old before they will do the second 80-year-old. And so again, so that builds on itself. As surgeon starts to do more older people, they want to see the results. As they see those results, which are typically very good, they start to do more. So all that takes time. And as an example of that, what we see in certainly some areas in the US is an increasing number of surgeries done under local anaesthetic because of concerns of general anaesthetic and the elderly. So these programs, the point is the programs take a while to play out. Even if we can point to the evidence in a paper, surgical practice takes time to change, and we're seeing that. And the biggest barrier, though, is back to the hearing aid channel and that education on what's the candidacy for a cochlear implant and what are the outcomes with a cochlear implant relative to a high-powered hearing aid.
Okay, thank you. And my next question is on, I guess, the acoustics market. Can you shed some light around Cochlear's work around increasing market access and expanding reimbursements for the acoustic product?
So, but yeah, on acoustics, most of the work that we are doing there at the moment is to expand the range of countries that we sell in. So over the last 18 months, we have increased, or 2 years, expanded our presence in Latin America for the Baha portfolio. This year and over the next few years, we'll open up some of the Asia Pacific markets for the Baha portfolio. And that takes a number of years as a regulatory approval. We are trying to work where there is already a reimbursed indication. But if we need to get a reimbursed indication, that takes longer again. So our work in Baha is more about geographic expansion than it is indication expansion, whereas our work in CI is very much about indication expansion, and that's because the geographic expansion is further advanced.
Thank you.
Thank you. Your next question comes from Gretel Janu from Credit Suisse. Please go ahead.
Good morning, Dig. Good morning, Brent. So just two questions from me. Can you elaborate a little bit more on pricing? So I know you've called out pricing pressure in Western Europe, but if you could give us a little bit more detail on what countries in particular you're seeing that pressure, and then what is happening to pricing in other regions?
So you've got to first split this by developed and emerging markets. So in emerging markets, we continue to see pricing pressure in tenders. That is natural. That's to be expected, and we're very confident of our ability to compete there. Equally, in emerging markets, in private pay, we have a tiered product offering and service offering. We have a tiered pricing. Where the latest technology is typically sold at least the prices that you would see through much of the developed world. So we're catering to affordability, different capacities for people to pay. In developed, as I said, the place we're really seeing pricing pressure is through some Western European countries. It's the smaller ones rather than bigger ones, but I don't want to go into the detail of which country at this stage. And if you look at our numbers and our ASP, you can't really see it, which gives you an indication of magnitude, but we think it's important to call out for the future, and I think there are not many pharma or medical device companies now that are reporting results that aren't talking about pricing pressure coming through somewhere in the world as governments try to manage health budgets. So I think it's a reality of the industry. What we're just trying to do is call it out and provide some some visibility looking forward, but without getting too much into specifics.
Great.
Having said that, though, we have defended it quite well in some markets as well. So.
Okay, cool. And then just secondly, on the tender market, so I understand it's quite lumpy, but can you give any kind of colour as to what you expect in the next 12 months and what you've factored into your FY19 guidance?
So we certainly factored emerging market growth into the guidance, and we do that based on, to the extent it's due to tenders, to the tenders that we can see, that we know we've won or think we have a high probability of winning. Still, there's a significant and growing the private pay or element to emerging markets, or more typical government reimbursement to emerging markets as well. So there are at least three elements to emerging market revenue. Obviously, as we set our guidance, we factor all those things in with the best ability we can, remembering that emerging markets revenue in total makes up about 20% of our total revenue.
Okay, thanks very much.
Thank you. Your next question comes from Chris Callos from Morningstar. Please go ahead.
Thank you for taking my question. I just had a question around China. You mentioned that you're stepping up the build out there. Can you just confirm the CapEx number in aggregate and how much of it is devoted to China over the next 2 years, and also maybe shed some light on the private payer market and how that's tracking? Obviously, you're quite positive on the growth of that market in particular.
Yes. So the capex will be around $40 million a year for the next 2 years for China. We've spent a little bit already, so and that's probably half of the capex for the next 2 years. And the main reason it's more than the initial plan is because we can build more cheaper, if you like, if we do it all at the same time. So it just makes sense to scale up the factory and future-proof it.
And on the China private pay, that market continues to grow well and grow consistently over the last several years. And that in that private pay there is self-pay. There is also an increasing level of reimbursement at city level or at sometimes a provincial level, which we bucket in private pay. So private pay is actually really non-tender. I think it's probably the best way to look at it. There's certainly a very, very significant opportunity, clearly. 95% of the implants that we do in China are in children. The penetration there is probably somewhere around 25 to 30%, so there is still a significant opportunity in children. Adults is still very early stages, but we are seeing, and I was up in China just 2 weeks ago talking to surgeons, that they are seeing a few more adults starting to come in the bigger cities. If you project forward to China and you look at China's development and investment in its healthcare system, in expectations for economic growth and consequent quality of life, standard of living, it's quite reasonable to expect continued pretty significant growth in the overall implant market in China to reach more children and over time to reach adults and seniors. That's why we're making a significant investment through both our factory but also through the P&L with expanding our on-the-ground team in China, which has grown very, very significantly over the last few years and will continue to grow. There is a very significant opportunity in all segments over the long run, and we're investing to capture that.
Just to follow up on that, would it be possible to get an idea of the quantifiable market as a multiple of the tender market?
So I'll give a little bit of detail. The more we give out on that, this is competitively sensitive. I think our view of exactly how that market is. But a few years ago, we said that the tender was less than half our business in China. That trend of the tender being less and less, and the non-tender being more and more, whether that's new implants or services, has continued, so that the national tender is a much smaller and smaller part of our overall China business.
And just one last quick one. Are you finding any of the same players that you're competing with in China, say Neurotron, for instance, popping up in Western Europe?
We haven't seen Neurotron selling into Western Europe. We've heard bits and pieces, but haven't seen any sales. Look, the regulatory barriers continue to rise with the EU MDR coming into effect through Western Europe. That makes it harder for everyone to get products approved, but clearly there is a value of scale and incumbency in that respect.
Great, that's it from me. Thank you very much.
Thank you. Your next question comes from Nick Cameron from Watermark. Please go ahead.
Hi, thanks for the questions. Really quickly, just one. What's the capacity that it gives you in China from this factory build-out, and is it mostly product that is made in China for China? Just want to understand the mix that's going to come out there. And then secondly, on R&D, where you're looking at indication expansion as the driver of future growth in developed markets, particularly the US, when can we expect to see some data that will I guess, show us directionally where that's going, or an inflection point there? Thanks.
Okay, so China capacity, we've effectively building a factory that will allow us to double the original capacity that we had set aside for China. It would obviously take time to fill that out and to grow that. That factory will supply beyond China. So it will be producing, we haven't said which products in our portfolio, but it will produce products from our portfolio at the same standard as we make from here. It will sell into China and into some other markets. The second part of the question was on indication expansion. Look, it's hard to say. So we saw the Japanese expansion come through last year. Looks like we're seeing some movement in surgery on the back of that. There is some work going on in a couple of countries right now that we hope will result in some expansion of indications in the near future. There's just been a minor change in Korea very recently. So this is work in progress, and it does take, none of this happens overnight. It takes time, it takes evidence, it takes a coalition of not just us, but surgeons, parents or potential candidates, all working together with government. It is very hard to predict when, but we have seen over the last few years some indications move. We expect to see some more of that happening over certainly the next year and the next several years.
Thank you.
Thank you. There are no further questions from the phones at this time.
Okay, if there's no further questions, we'll wrap that up. Thank you all for joining either by phone or in person.